Good afternoon, everybody. This is Michael Ward. I'm a Director of FWO Chartered Accountants, and welcome to our webinar today on creating long-term wealth by buying your commercial property within your self-managed superannuation fund. This is obviously a very topical discussion point because we have over 75 people registered for today's webinar, so that's a fantastic result, and I welcome you all. If for some reason you don't get the full content of the webinar, we are recording this webinar, so you'll be able to order a recording of it in case you miss any part of it. So just excuse me for one moment. Sorry about that. I just had a technical glitch with the mouse, but we should be right now. So what we're talking about here is acquiring commercial property in a self-managed superannuation fund environment. So it's probably appropriate to revisit what a self-managed superannuation fund is. It's a superannuation fund that's set up for the benefit of its members to provide retirement benefits for those members in the future. Self-managed super funds are administered by the Australian Tax Office, but there are certain rules that they have to, or criteria that they have to meet, one of which is that they must have less than 5 members. They're governed by the Superannuation Industry Supervision Act of 1993, the SIS Act. Now, in terms of a super fund being allowed to borrow, that is specifically allowed for under Section 67A of the SIS Act, where it allows a self-managed super fund to borrow under a limited recourse borrowing arrangement, or LRBA, to acquire a single acquirable asset. I'll come back to that in a moment and show you the sort of basic structure of a self-managed super fund with a borrowing. Under Section 66 2B of the Act, it also allows a self-managed super fund to acquire business real property from a related party at market value. Normally, a super fund can't buy any asset from a related party. However, there are 2 exceptions. One is listed shares and the other is commercial or business real property, and that's specifically provided for under Section 66 2B. And typically, banks will lend up to about 60% of loan to value ratio under a limited recourse borrowing arrangement. But under an LRBA, there has to be a certain structure established to enable this to happen, or to enable the financier only to have a limited recourse borrowing arrangement specific to that asset. And what needs to happen is that the property must be held by a bare trust with a custodian company as trustee, with the self-managed super fund as the sole beneficiary of that trust. So just looking at that structure and explaining how the limited recourse borrowing security works, the reason why the property has to be held in a separate custodian company as trustee for a bare trust, where the super fund is where the self-managed super fund is the sole trustee, is to identify the specific asset for which this borrowing is happening and set it aside separately in this bare trust, so that the financier, or a bank typically, takes security over the asset held by that custodian company as trustee for the bare trust for the purposes of the loan. Even though the sole beneficiary of that bare trust is the self-managed super fund, the bare trust structure with the custodian company puts that asset separate to whatever other assets are owned by the self-managed super fund. So therefore, a bank or any financier only has access to the asset held in that bare trust as security for its borrowing. And so any other assets that are in the self-managed super fund, and which there's most likely to be assets in the self-managed super fund, are not affected by the limited recourse borrowing arrangement that the super fund may enter into. On the right-hand side of this diagram, it's typically showing the structure we're talking about here. We're specifically talking about the situation where a current business owner owns the business premises from which they operate their business. And we're looking at the circumstance where they have a self-managed super fund who takes out a borrowing with a bank to buy those business premises from the related party, being the business owner. The property is then transferred to the custodian company as trustee of the Bear Trust. The bank takes security over that property held in the custodian company as trustee for the Bear Trust. But any other assets that self-managed super fund owns are held in the name of the trustees of the self-managed super fund and are not subject to the bank loan security. Once the property has been acquired by the custodian company as trustee for the Bear Trust for the sole benefit of the self-managed super fund, the business owner then rents that property from the custodian company under a lease agreement. And so they would pay commercial rates of rent across to the Bear Trust, and those funds are available, if you like, to within the Bear Trust through to the self-managed super fund to make P&I loan repayments to the bank. Commercial rent is another way of getting funds into the self-managed super fund for the future retirement of the members down the track, over and above the concessional and non-concessional contributions that members can make each year, either employer-sponsored or member contributions. This next diagram just is very similar, but it probably just gives the order of transactions as it happens in a proposed acquisition of a commercial property from a related party by a self-managed super fund. In this situation, the first thing that happens is the bank would lend money to the self-managed super fund, which in turn contributes those funds to the custodian company as trustee for the Bear Trust, of which the self-managed super fund is the sole beneficiary. The custodian company then uses those funds to purchase the business property from the current business owner who currently owns the property. And so that property, the title of that property is transferred to the custodian company as trustee of the Bear Trust for the sole benefit of the self-managed super fund. And from that point on, the business owner pays rent across to effectively the custodian company as trustee for the Bear Trust. And those funds can be accessed by the self-managed super fund to make principal and interest repayments on the loan. Over and above that, whilst that's a source of funds going into the self-managed super fund, the business owner can continue to make super contributions for the members into the fund as well. We have had a number of client situations in last year where we've done this precise transaction, and often where the current business owner, sometimes they've had the property owned by a related entity to the actual entity that's owning and operating the business. And in that circumstance, there is an existing lease agreement in place. So if the property is transferred by that related party to the super fund or to the custodian company as trustee of the Bear Trust, that's with an active lease agreement in place, that's considered to be a sale of a going concern, and that transaction would not have any GST involved in it. So that's alternatively, if you don't have an existing lease agreement, in other words, that the business property is owned by the current business owner, and all that's happening is that the business property is being sold to the custodian company as trustee for the Bear Trust, then that property sale is probably going to be subject to GST. And in those situations, financiers often will lend the additional amount required for the GST and seek repayment in 4 months' time after the first BAS or business activity statement is lodged by the self-managed super fund to claim back the input tax credit on the purchase price, or the GST input tax credit on the purchase price of the building. So that's how you handle the acquisition of a property, a commercial property that would be a taxable supply for GST purposes and would be subject to GST if there's not an existing lease agreement in place. So owning commercial premises in super, why it can outperform? The fundamental reason is that owning an income producing asset in the lowest tax environment will always create greater after-tax wealth. And the more after-tax dollars that you keep to reinvest or retire debt means that the debt can be paid off faster and more funds are reinvested. Obviously, the faster a loan is repaid, the less interest is charged and paid as well. So we need to revisit what the current tax rates in Australia are. For individuals, it's a scaled rate. The first 18,200, there's no tax rate applicable. From 18,201 to 37,000, it's 19%. From 37,001 to 80,000, it's 32.5%. From 80,000 to 180,000, it's 37%. And from 180,000 and over, it's 45%. Now, we have to add the Medicare levy to that, which is currently 1.5%. That's going to increase to 2% from the 1st of July 2014 with the introduction of the disability levy as well. So effectively, you can add an extra 2% to those tax rates there in terms of what the real tax rate is. For companies, they pay a flat 30% tax rate, and for superannuation funds, they pay a tax rate on normal income of 15%. The capital gains tax rates in Australia can be slightly different. Firstly, for superannuation funds, if the asset is held greater than 12 months, the effective tax rate is 10%, not 15%. And I'll come back to this point, but if the asset, if an asset is sold, if an asset owned by a self-managed super fund is sold at a time when it's paying pensions, retirement pensions to its members, then there is actually no tax rate applicable to the income of the fund. Companies still pay 30% tax on any capital gains. Individuals pay those same stepped tax rates depending on the level of income, but obviously there's a 50% discount for an asset if it was held longer than 12 months. And once again, you've got to add the 1.5% for Medicare levy, which is going to be 2% as from 1 July 2014 with the introduction of the disability levy. So what I thought I'd do today is present to you a case study that we've put through a profit, cash flow and balance sheet modelling tool that we use. And we've worked it out for 10 years from now as to when you buy this commercial property for $1 million plus GST. In this scenario, we've got a self-managed super fund that has funds of $450,000 already. So it's going to borrow $600,000 from a bank, and the repayment terms are principal and interest repayments over 10 years at an interest rate of 6% per annum. They're also going to borrow the GST of $100,000 on the property acquisition, interest only for 3 months, and they're going to repay that GST loan from the GST input tax credit they get, which might be up to 4 months later when you lodge the first BAS for the superannuation fund. In this case study, we're assuming that the rent will be equal to 12% of the purchase price, and we've factored in 3% per annum annual increases, and that our outgoings with respect to this property run at about 10% of the annual rent, and they're fully recovered from the tenant. So So that's another form of income for the superannuation fund. We also assume that the building is subject to a capital works deduction or depreciation allowance of $10,000 per annum, and there's legal fees and stamp duty cost on the acquisition of the property amounted to $41,025. So we've done these modelling for profit, cash flow and balance sheet out for 10 years under two ownership structures, one being owned by a self-managed superannuation fund and then one being owned by a property investment trust. And with respect to the property investment trust, we're assuming whoever the beneficiaries of that trust are, they're paying a marginal tax rate of 39% inclusive of the Medicare and disability levy. So under this model, under either ownership structure, either the self-managed superannuation fund or the investment trust, or the property investment trust, the bank loan is repaid or paid off after 10 years. But because of the low tax environment of the self-managed superannuation fund and the ability to reinvest a higher amount of after-tax dollars to either to pay off the home loan, the property loan faster, or to invest, the net assets accrued in the self-managed super fund at the end of 10 years amounts to $1,310,853. This is without even revaluing the property to what its market value might be at that time. Whereas, and that's after taking into account paying tax on whatever the net rent of the fund is over that period. Whereas in the property investment trust, we have the same net rental from the property accruing each year, but there's a higher tax rate paid by the beneficiaries of that property investment trust. And so there's less money to sort of grow at the end of each year. And under that modelling, their net assets accrued in the property investment trust at the end of 10 years amounts to $1,067,788, again without revaluing the property to its market value. So the result in comparison is that the self-managed super fund is better off by $243,065, which is quite a significant sum over 10 years. And it shows the effect of owning and earning income from an investment in a low tax environment, which is what self-managed super funds are. So the other aspect to think about too is that what happens when you sell this property at a capital gain at some time in the future. So under this case study, we've projected out 20 years, in 20 years' time, and assume that the property has grown in value to $1,750,000 and is sold at that point. In this scenario, the capital gain would be approximately $860,000, which is the sale price less the cost of sale being commission and legal fees, less the reduced cost base of when you acquired the property. Now that's its original $1 million plus costs, legal costs and stamp duty on purchase, but it's reduced by the amount of capital works deductions that have been claimed over those years. That $10,000 a year over 20 years is $200,000. So how that works is capital works deductions, effectively, whilst you get a tax deduction for them when you claim them, they actually decrease the cost base of the asset when you come to work out the taxable capital gain when ultimately you sell the building. So they claw it back, in a sense, at the time of sale. Now, under the property investment trust, under current rules, the capital gain would be eligible for a 50% discount, but the remaining, so the $860,000 capital gain would be reduced by 50% to $430,000, but the remaining $430,000 capital gain would be taxed at 39%, resulting in tax payable possibly of $167,700. I've assumed in this case study that this particular asset wouldn't be eligible for current small business capital gains tax concessions and satisfying active asset rules and things like that. However, on the self-managed super fund side, if it was owned by the self-managed super fund, we possibly don't have to worry about any of that, because if, say, in 20 years' time, the fund members are over age 60 are in receipt of a pension from the fund, in other words, because the fund is paying pensions out to the members, and because they're over age 60, it's not taxable income to them. The earnings of the fund become completely tax-free. So in that scenario, and we've actually had client situations where this has happened, when the fund is in pension mode, no tax is applicable to any income earned by the fund, including capital gains. So an appropriate strategy would be, in terms of timing of when to sell a property that's derives a capital gain, if it's inside the self-managed super fund environment, the optimum time to do it would be when the fund is in pension mode and members are over age 60, and there is no tax applicable to the earnings of the fund, including any capital gain derived. So under this case study, it's possible to avoid any capital gains tax at all on a future sale of the property, providing the fund is in pension mode at that time. And obviously, we're basing all of this on the current rules as they apply and assuming that they would apply in the future, which may not be the case, but all we can do is give advice based on what the current rules are. So what are the benefits, in summary, of ownership of commercial property by self-managed super funds? They achieve greater net assets or wealth accumulated over time because of the lower income tax on net income throughout the period of ownership. Therefore, more after-tax dollars are reinvested to grow. And also, possibly, there's no capital gains tax on the sale of property, depending on the timing of when the property is sold. And also, another extremely important point is that it offers asset protection from creditors. Assets owned in a superannuation, in the main, are protected from creditors. So that's something that should not be discounted as a major benefit as well. As I said earlier, we've actually had a number of client situations in the last year where we've done this very transaction where they've had commercial property that's been owned by either a related party or the current business owner that they use in their business, but they've also got a self-managed superannuation fund, or they've had superannuation funds with a life office or some other superannuation provider. In situations like that, we've set them up with their own self-managed super fund. We've rolled over the benefits from the industry fund or the life office fund, and that has provided enough cash together with the loan from the bank to acquire the property from either the business proprietor or a related party to the business proprietor. Depending on how that was structured, there is GST involved or there isn't GST involved. If there's an existing lease, then it's the sale of a going concern, and so no GST applicable. If there is GST applicable, extra funding can be sought from the financier and it gets repaid very quickly after getting the input tax credit back on the first BAS or business activity statement of the super fund after the property acquisition. And then obviously the custodian company as trustee of the Bear Trust for the sole benefit of the super fund enters into a lease agreement with the business proprietor, and commercial rates of rent are paid over and above the concessional and non-concessional contributions each year that are made on behalf of members by the employer or the member themselves, depending on their situation. So a combination of concessional and non-concessional contributions plus commercial rent gives an ability for the self-managed super fund in a very low tax environment to accumulate wealth at a very fast rate, and a much faster rate than what could have been done outside of the self-managed super fund environment in a higher taxed environment. And that basically is the fundamental reason why owning commercial property in self-managed super funds can often be a winning outcome, and because of that low tax environment, but also because it's also an opportunity to potentially avoid paying any capital gains tax on the ultimate sale of the property, depending on whether or not the fund is in pension mode. So I've tried to sort of condense this topic into a short presentation so as to not to bog down in too much detail, but hopefully you've got the gist of where ownership of commercial property by a self-managed super fund that borrows using a limited recourse borrowing arrangement can be a source of accumulating wealth at a greater rate. And we have practical client situations where this has worked and continues to work and provide significant tax savings and greater wealth accumulation for our clients. So I'd like to make a special offer to all the webinar attendees today that if they book a meeting today, they will receive a free, and that meeting can be agreed upon at a future date, but they will receive a free 30-minute phone conversation with me exploring the benefits of a self-managed super fund with a limited recourse borrowing arrangement to acquire income-producing property. So if you're interested, please call me or on at FWA Chartered Accountants on 0738 333 999 or email me at michael@fwo.net.au today and we can schedule in a free 30-minute phone conversation. So I hope you enjoyed today's webinar. I hope you got some value out of it. I hope you can see where getting commercial property into a low-tax super fund environment that eventually could become a zero-tax environment can offer significant tax savings on the net income it generates in a low-tax environment on the period of ownership, during the period of ownership, as well as providing asset protection and as well as potentially protecting from paying any capital gains tax on the capital growth of the property over time, depending on when that property is realised. So hopefully by showing you that case study, you can see the tremendous extra benefit of ownership through a self-managed super fund, what is possible. And I would be happy to discuss with you any particular scenario or situation that you might be in where this strategy may work for you. So I hope you take me up on my offer of calling today or emailing today to book in a free 30-minute phone conversation. So once again, thank you for participating in today's webinar. I hope you got value from it, and I look forward to talking to you again in my next webinar. Thank you very much.